Hey, how you folks doing today? It's your boy Lou from the Intelligent Hustler channel, here with another video. And in today's video, I want to talk to you guys about why the stock market is not an indicator of the economy of a country or the economy of the United States. And a lot of people think that the two are tightly related. They are to a certain extent, but just because the stock market is doing well doesn't necessarily mean that the economy is doing well, okay? And I'll explain to you guys why. Basically, think of it's like this. There's a very small percentage of people that own stocks in the first place. And it's like 1 or 2% of the country, okay, that controls about 80% of all stocks and bonds in the stock market. So we already have a quote unquote rigged system to begin with. So when the stock market is doing good, is only doing good for that 1 or 2% of the population, okay? That already leaves a very large amount of people outside of the stock market, and they have not that they don't have nothing, but they're not part of the stock market, right? So it becomes a situation where if the stock market goes up or down, that doesn't affect a lot of people. You know, it's a neutral situation. It doesn't affect them any way or any shape or form, unless we have a very serious recession. Then that affects stock prices, that affects a company's performance. It affects the banks. If it affects the banks, it affects loans. If it affects loans, it affects small businesses or people, mortgages, so and so. That's why in the 2008 recession, it was the housing market that got affected. Then it affected the stock market, and then it affected everyday average people, right? It wasn't like okay, we have issues in the stock market and then it trickled down to people. No, it was first housing market, stock market, then small businesses and then employees. You know, it wasn't like most people think it is. So in layman's terms, a economy, you can have all sorts of things happen in the stock market, and it doesn't necessarily trickle down to your average person. It doesn't trickle down to mainstream America, you know, which is weird, because a lot of people think that just because the stock market is up, they assume that the economy is up. If you really look at the numbers of how, and this just proves how segmented the economy really is from the stock market. You can have record highs on stock market performance, but then yet you can have millions of people still paying off their college debts, paying off their auto loans. You know, you can have massive inflation or housing prices in California or New York. You can have homeless people everywhere in California, but you still have record highs and record high performance in the what was it, in the SP 500 or NASDAQ or whatever else. So just because the stock market is doing well doesn't necessarily mean that mainstream economy are doing well. And also another thing too, not every company out there is publicly traded. You know, a lot of small businesses, they're not even in the stock market. You know, they don't have an IPO and things like that. So they're not part of that world, but they're still small businesses. They're still the backbone of most of the employment in this country, you know. So it's just a interesting thing to see. Of course it's false, but it's interesting to see when people claim that the stock market is just is an indicator of the economy when truly it's not. So that's all that I have for today. I'll see you guys in the next video. Peace out.